Hey y'all, I'm Roger Herring with Investors Accounting, and I want to welcome you to My 2 Cents. This is where I get to give you my opinion on a topic of the day. And today's topic is, hey, you're a corporation, you have to act like it. You know, I see a lot of first-time investors. They're out there, they're wholesaling, they're flipping, and they don't really understand the difference between operating as an individual or operating as a corporation. They look at it like it's their money. When you're flipping and wholesaling, guess what, guys? You're supposed to use an LLC. Tax is either a C or an S in most cases. The money that you make doesn't belong to you. It belongs to the corporation. Now, you can take it out, but there's some things that you cannot do, okay? The first and foremost thing that you got to remember is you cannot commingle. Commingling means you are paying your personal expenses with the assets of the company. You pull out the debit card at the pump and you fill up your wife's car. You pull out the debit card at the grocery store and you buy your groceries with the company money. You write a check for your mortgage and send it on in out of the company because it's easier just to write it out of the company than to transfer the money over to your personal bank account. Well, guess what? You're supposed to move the money to your personal bank account. You have to either do a salary, a distribution, or a loan payback. Those are one of three things that you can do to get the money out. That's the first thing. Now, the other problem that I run into, and if you haven't hit this yet, you're going to as a flipper or a wholesaler. Eventually, you're going to get stuck with a property. And you're going to be for sale, for rent, for anything. Just please God, get me out from under this hard money loan. When that happens, a lot of times people decide to repurpose the asset. They either want to move into it or they want to transfer it out to a different LLC and turn it into a rental property. Well, that's a corporate asset. And if you transfer it or repurpose it for your own use, what you've done is called a related party transaction. And there are very specific rules about that. Rule 1. It's deemed to have happened as if you sold it to yourself at fair market value. So you may only have $80,000 in a property, but fair market value might be $150,000. If there's a capital gain on the transfer, that capital gain is taxable to you. If there's a capital loss on the transfer, that loss is a non-deductible loss. So, is there a way to do this? Yes, there is, and a lot of it depends on how much debt you're carrying and do you assume debt. I'll be happy to sit down and talk with you guys about that and explain it in detail because it does get kind of complicated. But my point of today is you have to remember that there are rules. It's like my old professor Clyde de Glide said, if you know the rules, you can play the game. And you as a business owner have got to know the rules. Until the next time, this has been Roger's 2 Cents. Roger out.